Given the recent decline in financials in the third quarter of 2018, my co-portfolio manager, Kim Mertz, and myself thought it would be appropriate for us to do a little video and discuss with shareholders kind of what we're seeing in the market and what we've seen as far as any weakness out there and why that may have come about here in the beginning of the third quarter. I do believe financials are oversold. You know, it's been a tough last 6 weeks for financials. But you know, we just got through earnings season, and really the fundamentals are still in place. You know, we were a little concerned about the cost of deposits rising and how that would affect net interest margins. But all in all, I would say that you know, if we're talking about the banking sector as a whole and specifically small community banks, I thought net interest margins held in well, and I really think the fundamental growth story is still in place, and we're also still seeing some strong activity as far as M&A as well. This time period reminds me a lot of the end of the year of 2015 leading into the first quarter of 2016, where you know we saw from year-end 15 to about February 11th of 2016, bank stocks were down about 17%. And a lot of that came about, you know, in the fourth quarter, really in December, we saw our first interest rate increase. And that came about at a time when we were seeing a slowing in the GDP. So for four straight quarters, we saw GDP slow from 3.9% back in Q2 of 15 all the way down to only 0.5% in Q1 of 16. And people were afraid that we're raising interest rates while we're seeing a slowing in GDP. And it's very similar to what we see now. People are worried about the amount of interest rate increases we've had, the amount that may continue, whether Powell's going to overshoot, and then also whether the economy is strong enough to maintain itself with those increases. So deposit betas are usually looked at quarterly, and all that is really the movement that you're seeing from the cost of deposit at the beginning of the quarter to the end of the quarter and the increase therein. And what we've seen was, you know, deposit betas, despite interest rates going up, have been pretty benign until about the fourth quarter of 2017. And then we saw a big spike in the first quarter and then an even bigger spike in the second quarter. So the fear was that we were going to continue to see the rapid pace of increase in deposit costs in the third quarter as well. We did see an increase in the third quarter, but it really has started to kind of level off where kind of at the same level where it was at in the second quarter. And we actually think, so deposit betas usually lag interest rate increases by about 6 months. And we think in the fourth quarter, we'll actually have a pretty flat, benign deposit beta, which will help with net interest margins because we'll continue to see the yield on loans go up because of the recent rate increases. So, you know, since 2012, actually, we've seen at least 4% of the bank universe go away because of acquisition. We continue to see that in 2018. Actually, 2018 has been one of the strongest years that we've seen in M&A. It's up more than what we saw last year. We're seeing pricing better this year as far as last year we averaged about 1.6 times tangible book value takeout. And right now we're seeing banks being taken out at about 1.8 times tangible book value. We think that continues into 2019. You know, the environment is the same as far as small banks are having a tough time really generating enough earnings power because of the cost of regulation, the cost of doing business. And we think that continues. We don't think we're going to get an increased regulation, but that cost isn't going away. And as we continue, we're seeing more and more boards decide, you know, it makes more sense for us to join together with another bank and really take advantage of the efficiencies of scale. There's so many unknowns out there, but outside of any type of black swan events, you know, and I'll go through. We'll look at you know, what happens with China and the tariffs. Obviously, any type of issues as far as what's going on with the election here coming up in November will affect 2019 as well, if there's some unexpected kind of surprises with the elections. But and you know what goes on, you know, all the political stuff I would put in the categories of black swan event. But when I look at the fundamentals of banks, the fundamentals remain pretty solid. We have not seen any deterioration in credit quality. Banks continue to grow, and I also think, you know, that's not all dependent on the economy being strong. The economy helps, but also our small community banks are growing because they're taking market share from larger banks. and that's something that can continue into 2019. It's something we expect to continue into 2019. We also think that we will get some additional rate increases. We might not get the 3 that most people think or used to think we would see in 2019, but we'll get at least one more rate increase, I think, in 2019. We'll continue to benefit from the recent rate increase going into 2019, so you'll see some higher yields on loan portfolios. And additionally, I think you'll see some of the deposit betas, which we talked about in the past, the cost of deposits. We'll see some of that subside. So I actually think you'll continue to get some net interest margin expansion. And as a result, I think you'll continue to see pretty solid earnings growth in the bank sector. So I think, we're still positive on the bank sector in 2019, and our outlook is positive for it as well.